Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night on the membership side of our blog. So again, what we do is go over both the opening and closing and or adjusting trades that we make, and all of the trades that you see here are sent live via text message and soon to be email alerts to all of our members. And then we go over those trades tonight so that you guys can understand how we made them and what strikes we chose and all that stuff. If you're watching this video on YouTube, you have to understand that you're actually getting this video publicly about 7 to 10 days after we send out this video just to our members. So if you want this video and these trading alerts live time and right away, then you have to sign up for our free trial at OptionAlpha.com. So today we had a fairly busy day for the first day of the week, and I wanted to go over first the trade that we made on Friday last week. Since it was only one trade, I tend not to do a video for just one trade and waste your guys' time. So I threw that one in here. But we had bought a vertical on Priceline, and the vertical spread that we bought was the 1370-1360 debit put spread. So notice that the difference in the strikes is $10, and what we like to do is pay about half the difference in the strikes when we're buying a debit put spread or a debit call spread. The reason is because we want this to be a true 50-50 trade. It's a low volatility trade. We're just making a directional bet and assumption on where Priceline is. I've actually made some good money on this trade today, but I'll go to the chart so you guys can see it, but you'll see exactly where we traded here. This debit put spread on Priceline, and today Priceline closed lower, so that obviously helped our position, but we're going to hold on to it for a little bit. Basically what we're looking for here is that even though Priceline's implied volatility is below 50th percentile, we really want Priceline to kind of finish out this month and next month anywhere below this line here. So this is not a trade that will hold all the way through expiration. Since it's originally a 50-50 bet, as soon as we start seeing a nice little profit, we're going to probably exit this trade. We're not going to try to hold it out for max gain, not even close. All right, the other trade that we entered today was a vertical credit spread, and this was on EWW, and we sold 7 of these spreads there for April. So we're starting to move our portfolio further and further away from March. Now the March is getting a little bit closer. We had sold the 58.57 put credit spread, and we took in a credit of 28 cents. So we sold the 58 strikes here and bought the 57 strikes to help finance the sale. All in all, at the end of the day, the difference between those is we took in a 28-cent or $28 credit per spread that we sold. So we took in 7 of those spreads, so you can do the math in your head. Took in a nice big credit on that. So EWW, you'll notice the first thing is that implied volatility, even though it's a little bit hard to read here, is at the 60th percentile. So that already checks the box off for implied volatility over the 50th percentile. We know right away that we want to be net sellers of options, not net buyers. We don't want to buy options when they have really high implied volatility. All we're doing is buying junk. And then as you can see, EWW has been trending much, much lower over the last couple weeks. So we're being a little bit more contrarian, and we need some positive delta in our portfolio anyway. So we went ahead and sold the 58 strikes down below and bought the 57s, which are a couple dollars, about $1.50 below where we're at right now. Now, if we actually go to the trade tab, and I want to go over this so you guys can see this as well, and you'll see our position in EWW for April, and you'll notice where our strikes are. Now, it's moved against us since we actually entered the trade, and we're down about 17 bucks on the trade, which is not bad at all. But you'll notice where our strikes are down below the market at about the 35.5 percentile, or 35.5 probability level. So that's where we were when we entered the trade. Right now, those strikes, those first strikes at 58, have about a 41% chance of being hit, meaning that by April expiration, there's about a 60% chance right now that EWW does not close below 58. It could trade below 58, but statistically speaking, there's about a 60% chance that this stock trades above that level by expiration in April. So we're going to hold on to this one. It's a very good trade for us, nice position size, and pretty easy fills. It looks like a lot of other people got filled in this trade here today as well. The next trade that I wanted to go over real quick is the XRT trade. So this one's a little bit different, and I want to spend some time on this tonight. But what we did here is we actually had a broken wing butterfly in XRT. And what we had originally had was the 80, 79, 77 put spread. And so you'll see what we did here is we bought back today the embedded vertical spread of 78.77, and we bought that back for a minor debit of 3 cents. We actually tried to fill this thing at 2 cents, but just wouldn't fill, had to bump it up to 3 cents per spread here. So we bought that back for 3 cents. But we originally had this broken wing butterfly in XRT, and I want to use the Analyze tab because I think it really drives home the point of where we're at here. And let me just go ahead and show you guys. Let me just open this up so you guys can see exactly where our strikes are right now. So this is right now where we are with the XRT position. We basically, by buying back that embedded short spread, we are long a butterfly in XRT centered around 79. Now the stock is trading all the way up here above 85. So a lot of people ask to say, Kirk, well, why did you do that? Why did you make that adjustment? Because we actually really start to make a lot of money when the stock falls to 79. Now, I don't think it'll actually get down there, but here's what I do know. If you look down here in the bottom left-hand corner of the screen, you'll see that our profit loss diagram does not go anywhere near or below zero. So by buying back this embedded spread on this broken wing butterfly that we originally had, we have basically locked in a sure profit on XRT. And not only that, but we've also given ourselves an opportunity via this window here around 78, 79 to actually make even more money on this thing if XRT continues to fall or even starts to fall between now and expiration. So by buying back this spread, which only cost us $3, we locked in a profit and also gave ourselves an opportunity to make a big profit on this thing if XRT moves back. But again, I don't think that's going to happen, but I want to give myself that opportunity. Now remember, our original position was that we were long the 70 or long the 80s, short the 79s, which is only one strike away, and you'll see here that we were originally long the 77s. So we had totally skipped over the 78 strike. And what that allowed us to do on this trade was take in a credit from the beginning. So our actual broken wing butterfly looked a little something like this as opposed to what it has right now, and allowed us to take in a big credit should XRT move higher, which is exactly what happened. And so we took advantage of that by then, again, moving and taking out that 77 strike and moving into the 80 strike. So now we are long the 80, short the 79s, and long the 78s, creating a very even butterfly, but again, locking in profit. So I know those are a little bit complicated. It is a more advanced adjustment, but again, as you start to see some of these adjustments happen, you'll get used to how we send out the alerts and adjustments. All right, so for closing trades today, we closed out a vertical call spread that we had on Cisco for about 2 months now. This one's actually a real great winner, a great story to tell. It was originally a trade that we put in January for February expiration, kind of ran all the way up until February expiration, and we rolled this contract from February to March at the last minute. It was kind of still on the dance floor. It could have gone either way. We didn't want to risk it. So we actually rolled the contract from February to March. And then today we closed out the trade with a 13-cent debit, made a total of $24 per vertical after rolling. So when we rolled this contract, we actually took in a credit when we rolled, which is always what you want to do or try to do with rolling vertical spreads. Always taking a credit, you're adding more time, adding a little bit more risk, taking a credit, and we did. And even after that additional credit that we took in a nice profit of $24 per spread after rolling. Really, what was the whole idea behind getting out of this is nothing more the fact that Cisco has continued to move down, which has really helped our position. You'll notice that it's been kind of a wild ride here in Cisco in the last couple months since the beginning of the year. It's just been up and down and up and down. And since it's come back down to a nice level of support where it's been before, it'll likely bounce from here. At least that's what we're expecting. And it's also been previous areas of resistance going back all the way to December and November of last year. So I don't want to risk it and try to eke out and squeeze out every little ounce of profit in this thing left. We've obviously made a really good decision by rolling it. It turned out to work in our favor, so we're going to go ahead and lock in the profit here and just move on to the next trade. In addition, you can see that implied volatility has gone down, so that's really helped our position. And now that we're after earnings, that'll just keep dropping, and that's really helped kind of decay some of the premium that's left. All right, and then the last trade that we closed out today here was a really good trade in Tesla. We only were in this trade for a couple days now, but we had sold a credit call spread in Tesla. It was the 280, 285 call spread that we sold, and we bought it back today for a 45-cent debit. So we made $77 per spread that we bought back in. Again, the name of the game here with Tesla, as with a lot of the other things, is that implied volatility has dropped. You can see it's back down below the 50th percentile. We sold this spread when implied volatility was above that 50th percentile. So we're giving ourselves a chance to be successful by trading the right side of volatility. And on top of that, we actually sold the spread practically at the highs of where it's been. And you can see it's actually come down about $10 from there. So I don't want to risk it. Again, Tesla is a very, very volatile stock. I don't want to risk trying to squeeze out every last penny and try to make another $45 on this when you can see that it closed up at the end of the day. It could just continue to move much, much higher than here. It's a very volatile stock, but we did have an opportunity to trade the right side of volatility. And if you continuously do that month after month, year after year, you will definitely have some income rolling into your bank account. So again, hopefully you guys really, really enjoy these video tutorials. They're always here for your guys' help. And that's what we're trying to do here at Option Alpha. So if you have any questions or comments, please feel free to go ahead and drop a comment right below this video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.